For much of the past decade, capital discipline took a backseat in publicly traded U.S. firms. Growth was the priority. Companies invested aggressively, expanded headcount quickly, pursued large acquisitions, and poured money into new initiatives with uncertain payoffs. As long as revenue was rising and capital was cheap, markets were willing to tolerate inefficiency, losses, and ambitious spending plans. That era is over. Today, capital discipline has returned as a central principle of corporate strategy across publicly traded U.S. companies. Firms are becoming far more selective about how they deploy capital, what they invest in, and how quickly they commit resources. This shift is not temporary. It reflects structural changes in the economic environment, investor expectations, and the cost of making mistakes. One of the biggest drivers behind this return to discipline is the cost of capital. Higher interest rates have fundamentally changed corporate decision-making. When borrowing was inexpensive, companies could fund expansion with little immediate pressure to generate returns. Projects could take years to pay off. Today, capital is more expensive, and every investment must justify itself more clearly. Weak or speculative projects struggle to clear higher return thresholds. Investor expectations have shifted in parallel. Markets are no longer rewarding growth at any cost. Instead, investors are focused on cash flow, margins, and return on invested capital. Public companies are being judged not just on how fast they grow, but on how efficiently they use their resources. Firms that demonstrate discipline are rewarded with higher confidence and more stable valuations. Another key factor is economic uncertainty. Growth forecasts are less reliable than they were in the past. Capital discipline is also closely tied to decision reversibility. Leaders are increasingly distinguishing between decisions that can be undone and those that cannot. Reversible decisions are treated as experiments. Irreversible decisions are scrutinized heavily. This framework helps leaders avoid locking the organization into fragile paths. Knowing when to slow down is now as important as knowing when to act. Technology investment highlights why this matters. AI, automation, and digital systems require significant capital and long-term commitment. Disciplined leaders resist the pressure to invest aggressively just to signal relevance. Instead, they demand clear use cases, phased deployment, and measurable outcomes. They understand that technology spending without discipline can weaken the organization rather than strengthen it. Mergers and acquisitions further illustrate the leadership dimension of capital discipline. Large deals often promise strategic transformation, but they also introduce integration risk, cultural disruption, and financial strain. Disciplined leaders approach acquisitions cautiously. They challenge synergy assumptions, stress test downside scenarios, and walk away when deals do not meet strict criteria. Knowing when not to buy has become a mark of strong leadership. Capital discipline also influences how leaders manage cash and liquidity. Holding reserves was once criticized as inefficient. Today, leaders recognize that liquidity provides control. Disciplined leaders ensure the organization has the financial flexibility to respond to shocks, invest opportunistically, and avoid forced decisions. This requires resisting pressure to deploy every available dollar. Workforce decisions are another area where capital discipline shows up clearly. Hiring ahead of demand ties up capital and increases fixed costs. Disciplined leaders align headcount with confirmed needs and invest in productivity rather than scale alone. This reduces the likelihood of disruptive layoffs and preserves long-term organizational strength. Investor communication has changed alongside leadership expectations. Disciplined leaders are more careful with guidance and promises. They avoid projecting aggressive outcomes that depend on ideal conditions. Instead, they communicate realistic plans and explain how capital decisions support durability. This transparency builds confidence even when growth is modest. Capital discipline also requires emotional control. Leaders often face pressure to act quickly, match competitors, or pursue visible growth initiatives. Discipline means resisting urgency when it is not justified. It means being comfortable with slower progress if it preserves long-term value. This emotional restraint is a leadership skill that becomes more valuable in uncertain environments. Another reason capital discipline is now central to leadership is the interconnectedness of modern businesses. Capital decisions affect operations, culture, risk exposure, and reputation simultaneously. Leaders can no longer treat capital allocation as a narrow financial exercise. It is a strategic act that shapes the entire organization. Boards increasingly expect this mindset. Directors are asking tougher questions about capital use, return thresholds, and flexibility. Leaders who demonstrate discipline earn greater autonomy and trust. Those who do not face increased oversight. Capital discipline has become a key factor in leadership evaluation at the highest levels. Importantly, capital discipline does not mean avoiding risk or innovation. It means choosing risks deliberately. Disciplined leaders invest where returns are durable and aligned with strategy. They avoid investments that depend on perfect execution or favorable conditions. This selective approach allows innovation without fragility. This shift has also changed how success is measured internally. Leaders are evaluated not just on growth, but on return on invested capital, cash flow impact, and resilience. Capital discipline is rewarded as a sign of maturity and competence rather than caution. In 2026, why capital discipline is now a leadership skill comes down to one reality. The environment no longer forgives careless capital decisions. Growth alone cannot compensate for poor allocation. Strong leadership is defined by judgment, restraint, and clarity under uncertainty. Leaders who master capital discipline are not necessarily the most aggressive. They are the most intentional. They understand the cost of capital, the risk of irreversibility, and the value of flexibility. They know when to invest, when to wait, and when to walk away. In a business world shaped by volatility and tighter constraints, capital discipline separates leaders who react from leaders who endure. It has become a defining skill, not because leaders want it to be, but because the environment demands it.